March 2023 was a busy month for the financial markets. It started with a big storm and kind of things died down towards relatively calm waters towards the end. Now, whether this calm is there to stay or is it just a lull before the big storm, that is really the big question. Greetings, viewers. You're watching Aman Sangha, Independent Financial Advisor in Mississauga, Ontario. Now, for my update for the month of April, what I'm trying to do is address some of the questions that came up during the month of March, mostly from clients. There were requests for redemptions, there were requests for cashing out positions, there were requests of what it holds for the future. And those are some of the questions that I want to address in this update. And as always, I'll break it up into, I'll start with the index returns, how have the markets done. I'll touch briefly on banking crisis. And then finally, I want to touch upon the outlook for what could unfold for the North American economy going forward, at least for 2023. Now let's start with the index returns. I'm not going to be spending a lot of time on this one, but you can see that so far the equity markets are holding up the good run we've had so far. And I'll touch briefly on this when I come to the third point. But if you look at the standout performance, it's from NASDAQ. And if you've been tracking the returns on a month-to-month basis, you can basically say it was 5% end of January, 10% end of February, and 15% end of March, which is a stellar performance, which makes you think, is it too good to be true? Because really it's unsustainable on a very long-term basis. The others, I won't spend much time other than the fact that gold has been the other asset, which is kind of close to 10% return right now. But without spending more time here, I want to get on to the second part, which triggered a lot of questions for the month of March and was related to the banking crisis. Now, it's if you look at the nature of the crisis, whether it was SVB, First Republic, it was triggered by what you could call as a paper loss. The banks had a lot of treasuries bought when the interest rates were high. As the interest rates went up, those treasuries fell in value. Now, because they are marked as available for sale, banks have to mark them down. So it's really a paper loss. If they don't sell it, it's a paper loss. But if that loss triggers a bank run, the bank is then forced to crystallize those losses because they are selling into liquidating those holdings to satisfy the demands of the depositors. So that, in a nutshell, is the crisis. It seems to have stemmed for now. Whether we have seen the last of it, that's very hard to say. But we could probably see more of these to happen just as things unfold. But bottom line is there is interest rate risk when you have treasuries for banks, when you have treasuries on your balance sheet, which have been bought at low interest rates, and now the interest rates are, the way they are. And which is basically what I'm going to be discussing a bit more in my third topic, which is despite everything that's going on, the Fed had a 25 basis rate hike mid-March. And so you're close to 5% for the Fed right now. That's the dark blue line. The market, and this kind of ties to the good run we've seen for NASDAQ, is the market is expecting a rate cut later part of 2023. Whether this happens or not, is not is something that I'll just touch upon briefly. But the Fed did go ahead with the rate cut. The good news was it wasn't a 50 basis points, it was just 25 basis points. Now, if you look at the dot plot from the Fed hasn't indicated any rate cuts for 2023. From all indications, they're going to hold at 5%. Probably in 2024, we might have 100 basis points cut for the 2024. That's what we can interpret from the dot plot. But that's not what the market is interpreting, at least from what we are seeing from the returns. So there is a potential volatility ahead because there is a disconnect between what Fed's been telling us and what the market has been pricing in. It could end up somewhere between the orange line and the purple line. That's the best case guess, but we don't know for sure which way this will, the pin will drop, the shoe will drop. So despite all this, the Fed's been raising rates, and I'll come to that. The big story there is to fight inflation. Now the yield curve is negative. That is recessionary. The lending conditions are tightening, which is again slowing down the economy, which, as per Fed, is to slow down the economy so that we can control inflation. So inflation control stays the big story. So the question is, how successful has been Fed at controlling inflation? And if you look at this, this is the month-on-month core inflation numbers. If you look at the last month, it came at about 0.3%. The month prior to that was about 0.6%. So on an annualized basis, inflation is anywhere between like 4% or 7%, which is far, far out from the targeted band of 2%. So which is the big question, which has been a lot to do with market pricing in a rate cut. At this point, it's unlikely with inflation so high that we will have a rate cut. If you look at from the scenario, if you put this into bigger picture perspective, inflation is strong and growth is slowing down because interest rates are hiking, lending conditions are tightening. That's a typical scenario for stagflation. Now, unless there is a big event like a major crisis that causes the Fed to change its route, it's unlikely that the rates would be cut for the second half of 2023. So which brings to the bottom line question. We are where we are at this point in 2023. There is always investment ideas which do well in different phases of the market. I always suggest know your risk appetite, see what you're comfortable with, and if there is something that you want to discuss, I'm happy to call 905, happy to chat. The number to call is 905-363-5035. Thank you so much, and bye for now.